How the rich get richer. Money in the world economy. As the few continue to amass riches while many people find it difficult to make ends meet, the growing wealth disparity is a defining issue of our day. Systemic benefits that benefit the wealthy, access to investment opportunities, and economic policies all contribute to this problem. Examining important elements that sustain wealth concentration in the hands of a select few, such as inheritance, monetary policy, and technical developments, is necessary to comprehend how the rich get richer. Here are 7 critical points that shed light on this complex issue. Number 7. Access to capital. One of the main advantages that affluent people have is access to finance, which allows them to participate in high-return ventures that are frequently out of reach for the typical person. Personal wealth, established credit histories, and social ties that enable financial transactions are all components of this multi-layered access. Rich people can obtain financing at cheaper interest rates than less wealthy borrowers, since they usually have substantial assets that can be used as collateral for loans. Furthermore, they frequently have connections with banks and other financial organizations that give them special treatment, such access to private banking services or exclusive investment products. Their involvement in investment networks, where they can meet venture capitalists and angel investors eager to finance creative ventures, further improves their capacity to raise money. Because these endeavors typically yield larger returns than traditional savings accounts or publicly traded stocks, wealthy people can now invest in real estate development, startup capital, or private equity. Average people, on the other hand, can encounter obstacles that limit their capacity to efficiently increase their wealth, such as rigid lending requirements, elevated interest rates, and restricted access to investment options. Number 6. Compound interest. For wealthy people, the idea of compound interest is essential to building wealth. Wealthy people profit from the compounding effect, which causes their investments to expand exponentially over time when they make large investments in a variety of assets, including stocks, bonds, real estate, and mutual funds. Take, for instance, a $1 million investor who receives an average 8% yearly return. The investment grows to $1.08 million after a year, to almost $1.1664 million after 2 years, and to over $10 million after 30 years because of the compounding effect. Rich investors can profit from both the initial cash and the returns produced in prior eras thanks to this potent idea. Furthermore, rather than taking dividends or rental money out for personal use, wealthy people frequently reinvest them back into their assets. Their wealth grows even faster as a result of this behavior. On the other hand, people with lower levels of capital might find it difficult to attain comparable growth rates because they might not have enough money to invest at first, or might need to take money out for emergencies or living expenses, which would interfere with the compounding process and restrict their long-term financial growth. Number 5. Economies of scale. Economies of scale have a major positive impact on the financial management strategies of wealthy people. As their wealth grows, they are able to pay for full-service financial services that offer customized risk management plans and investment strategies for high-net-worth customers. Access to prestigious financial advisors or wealth management companies that specialize in handling sizable portfolios using complex strategies that maximize returns while lowering risks is frequently one of these services. Rich clients have access to special investment possibilities, like hedge funds and private placements, which are usually only available to certified investors and have high minimum investment requirements. Because of their specialized character and restricted accessibility, these investments frequently provide larger returns than conventional investments that are offered on public markets. Furthermore, affluent people might attain greater returns through effective management techniques that are impractical for smaller portfolios because the cost of managing a large portfolio tends to decline per dollar invested. For instance, a wealthy person with millions of assets may bargain for reduced costs depending on the magnitude of their investments, increasing overall profitability, but a small investor may pay a greater percentage of fees in relation to their total assets under management. Number 4. Tax optimization. One important tactic used by affluent people to maintain and increase their wealth over time is tax optimization. The wealthy frequently use complex tax planning strategies that take advantage of legal loopholes and advantageous tax laws intended for high net worth persons. For example, when transferring wealth to their heirs, many wealthy people use different structures like trusts, such as family limited partnerships or irrevocable trusts, to save estate taxes. In addition to giving heirs flexibility over how and when they receive their inheritance, these vehicles can also protect assets from taxes. Furthermore, wealthy investors frequently utilize tax-advantaged accounts, such individual retirement accounts or 401k plans, which permit tax-deferred growth on investments until withdrawal in retirement, when they can be in a lower tax bracket. Wealthy people are also encouraged to concentrate on investment income rather than earned income from wages or salaries, since capital gains taxes, which are levied when assets are sold for a profit, are frequently lower than conventional income tax rates for high earners. Wealthy people can further reduce their tax obligations by using tax loss harvesting strategies, which involve selling failing investments to offset gains, or by carefully timing the sale of assets. They can reinvest the savings into more wealth-building possibilities, in addition to keeping a larger portion of their profits thanks to this clever tax strategy. Number 3. Financial literacy. In order for wealthy people to successfully navigate intricate financial markets and make well-informed investment decisions that contribute to their wealth creation, financial literacy is essential. Many wealthy people have access to excellent education and resources that help them better understand complex financial ideas, including market dynamics, risk management, asset allocation, and diversification tactics. They frequently take part in exclusive networks where they can gain knowledge from other prosperous business people and investors who offer their perspectives on new developments and investment prospects. This information enables them to make well-informed decisions about where and how much to invest, free from hunches or irrational judgments. Furthermore, rich people usually have access to cutting-edge financial tools and platforms that offer market research and real-time data analysis resources that enable them to keep an eye on performance and make proactive strategy adjustments. Those with less financial literacy, on the other hand, might not have the self-assurance or expertise necessary to successfully handle investment possibilities. This could lead to lost opportunities to build wealth or bad investment choices that result in losses. Number 2. Global market access. By giving affluent people unparalleled access to global marketplaces that present a wide range of investment opportunities outside of national borders, globalization has completely changed the economic landscape. Because of this access, wealthy investors and business owners can diversify their holdings across a range of industries and geographical areas, lowering risk and increasing possible profits by exposing them to a range of global economic circumstances and growth rates. A wealthy investor might, for example, decide to put money into emerging markets, where economic growth rates are much higher than in developed nations. Because of rapid industrialization or technological advancements, these markets frequently offer exceptional opportunities for sizable returns. Furthermore, having access to international markets allows affluent people to profit from trends that may not yet be completely realized in their local markets, such as the move toward renewable energy or technical innovation. Number 1. Inheritance and intergenerational wealth. In a process known as intergenerational wealth transfer, inheritance is essential to wealthy families' ability to maintain their wealth over time. Rich families can leave significant assets to their heirs, either at death or through lifelong gifting plans intended for estate planning, such as cash reserves, real estate holdings, stocks, enterprises, and priceless collectibles. From a young age, This transfer of money offers descendants substantial financial advantages in addition to material possessions. They also acquire important expertise about efficiently managing wealth, frequently through guidance from parents who have successfully negotiated financial markets. In the end, our economic system's architecture are firmly rooted in the ways that the wealthy get richer. Rich people take use of a number of benefits that help them accumulate wealth, such as improved access to finance, the power of compound interest, strategic tax efficiency, and access to international markets. If you liked our video, please hit the like button and subscribe to our YouTube channel.